Hello everyone, welcome to Atomic ACCA's Pre Mock Exam Solving Series, and in this video we are going to look at question number 3 of SBR March 2025 exam. Just like always, let's start with the requirements. Using Exhibit 1, explain in accordance with IFRS 16 leases why the server contract contains a lease, and explain with calculations how to measure the carrying amount of the right of use asset and the corresponding lease liability in the financial statements of Jared Company as at 31st March X3. So this is about leases, altogether 9 marks. Roughly we can say it's about 4.5 split. So we're going to talk accordingly, and we have to talk about the technical part, we have to talk about the case study as well. So we don't have to make it too long in order to score that 9 marks. Second part is more related to some numericals, and we're going to explain that. So that's about IFRS 16 topic. Second one, B1, discuss the reasons why cryptocurrency may not meet the definition of cash or cash equivalent or that of a financial asset, which means it's not IFRS 9 either, but may meet the definition of an intangible asset. Why not cash? Why not cash equivalent? Why not financial asset? So if we give a 2 mark explanation for each of this, we get 6 marks. No, I mean roughly speaking 2 marks each. Then finally about intangible asset, why it is, maybe a rough 2 marks over there as well. Altogether it's 7 marks, but I just gave a rough idea about 1.5 to 2 mark worth of points you have to talk about each of this. Note there is no need to refer to a specific exhibit to answer part B1, which means theoretically if you know the topic already, you're good to go and write this answer. You don't have to read the case study at all. So if in case you're running out of time during the exam or so, you can easily score this mark without even reading the case study. Keep in mind. B2, using exhibit 2, discuss the steps that Jared Company should take to measure the fair value of the cryptocurrency in accordance with IFRS 13 fair value measurement at 31st March X3, and briefly explain the impact of fair value measurement on the company's financial statement. So first part we are going to talk about IFRS 13 and how some fair value of cryptocurrency is to be taken. And is very important, so you have to address the second part as well. You have to explain briefly how this is going to hit on the company's financial statement. So that is probably related to exhibit 2. So let's first deal with exhibit 1. Before that, we do not want to open this tab anymore, so we're going to copy paste this into our answer sheet. Exhibit 1, explain 9 marks, question B, no need to refer, 7 marks, B2, using exhibit 2, discuss. Okay, so we have all of this and briefly explain. Okay, all right. So we have our questions ready so that we don't open the requirement tab anymore. Cool. So let's start off with exhibit 1. Before that, let's see if there is anything useful in the introduction tab. Generally nothing we find over here, but still let's read this. Jared Company prepares financial statement in accordance with IFRS accounting standard. Financial year end is 31st March X3. The following exhibits available on the left hand side of the screen provide information relevant to the question. Server contract. Okay, this is the IFRS 16. Explains a contract that Jared Company entered into with service company. Okay, service company on 1st April 20x2. That means 1 year before, to install a server. Cryptocurrency, that is second exhibit, describes the purchase of cryptocurrency by Jared Company on 1st Jan X3. Year end is 31st March X3, so 1st Jan means 1st Jan X3, Jan, Feb, March, 3 months before the year end. And how directors are considering measuring it. All right. So let's go to server contract, first one. On 1st April X2, Jared Company entered into a 5-year contract with service company for digital services. Under the agreement, service company installed a hardware based server, a physical device, so it's a tangible asset, which manages access in a computer network at Jared company's head office for the duration of the contract. So service company installed some kind of a physical device in Jared company's head office, and that is a physical device and it is used to manage the company's computer networks, and that's a server basically. The server is explicitly identified in the contract. Now this word is quite straightforward, telling us that it is a lease, because one of the lease criteria is that there needs to be an identified asset, and that's already given over here. It's a physical device. Okay, so we have an identifiable asset, and it's also specifically mentioned in the contract as well, explicitly identified. So that's like a direct straightforward point we can use in our answer. And service company can only change the server if in case it stops working. Jared company controls the data which is stored on the server. Jared company controls the data which is stored on the server. Okay, control is there with Jared company, meaning the customer, which is stored on the server and has integrated the server into its operations. Service company maintains the server and provides data backup and software upgrades. So they are doing the maintenance work. Service company cannot determine how the service server is used during the term of the contract, nor can it decide whether to modify the server or use it for another purpose. So first one, Jared company is controlling the data what is there on server. Number two, service company cannot determine how the server is used during the contract. Next, they cannot modify the server or use it for another purpose. Moreover, one more point was mentioned. Service company can only change the server if it stops working. All of these points are an indicator that though service company is the one that has installed this particular server to Jared company is completely controlling this particular thing. So control has passed to that other party. So we have well enough points over here to state control is there with other party, and another few points over here to state that this is a very specific asset as mentioned in the contract. Now, there are 5 annual payments to be paid under the contract of 5 annual payments. Okay, 5-year contract, 5 annual payment to be paid under the contract of 1.05 million in advance beginning on 1st April X2. So this is an advance lease. Jared company will receive cashback of 525,000 on the first anniversary of the contract. That means 1 year when it is done, 525,000 will be returned to Jared company. Then there were direct legal cost of 100,000 paid by Jared company. Fair value of server is 5 million on 1st April X2, and the interest rate implicit in the contract is 5% per annum. So this is all related to number work. Then useful life of the server is 5 years. Okay, there is no residual value and no option to purchase the server at the end of the contract term. Legal title to the server remains with service company throughout the period of contract. So this is also a slight indicator that this is a lease, because legal title is with service company, and at the end of the contract, Jared company cannot purchase this, which means it is going back to service company. But during that contract period, control is completely with Jared company itself, which means though legal title is with service company, Jared company is the one controlling it. So they have a right of use over here. This is what we are going to direct our answer to. Jared company pays for the insurance and maintenance of the server separately from the annual payment. So it's mentioned over here earlier. Service company is maintaining the server and provides data backup and software upgrades. But now you can see over here, Jared company is paying for that maintenance of the server and all. So that is also basically being taken up by Jared company. So another point to state over here is all the risk and reward of using that particular server is with Jared company, though the legal title is with service company. So this is all an indicator that control has passed. Now we have all the points needed. Cumulative present value of $1 discounted at 5% for 4 years is 3.546. We'll deal with that later on. That's all related to the numerical part. So let's answer the first part over here. Explain in accordance with IFRS 16 leases why the server contract is a lease. So why we have to account it for like a lease. This is what we have to talk about. So during the discussion, we mentioned 2 to 3 main points over here. First one was about control of that asset being passed to the other party. We told about how we connected the fact that control is passed but legal title with service company. Then we made another point related to having a separate physical asset. So separate identifiable asset is there. So we mentioned about that point as well. Another thing we mentioned is about the risk and reward, that is again related to the control. So we can state over here itself, risk and reward. Considering that, again, just keep in mind of the rough mark allocation. The whole question, including the number work, is 9 marks. So if we split around 4 to 5 marks for each of this, the topic which we are going to deal about, that discussion, is worth 4 to 5 marks, which we are going to write now. Out of that 4 to 5 marks, half will go for technical part, half will go for connecting it to case study, which means we don't have to elaborate too much figuring out the whole IFRS 16 standard. Rather, these 2 points, if we know, just elaborate on this, connect it to case study and say why these points are matching over here, and tell hence this is why IFRS 16 is to be used. So this is how our structure is going to be. So first let's talk about the technical part. IFRS 16 leases is to be applied in scenarios where we told about the legal factor and all, so we can just bring that up over here. In scenarios where an asset is transferred to another party lessee by the original owner of the asset, lessor. Now we're going to be a little more specific. It's not that simply they transfer it to other party, control is passed. In this transfer of asset, control over the asset is passed, and hence the and control over the asset is passed. Now we can slightly say, what does control mean? Control can be defined as a situation where the substantial risk and rewards of using that specific asset remains with the customer. So we explained in simple words what does control mean. Now risk and rewards, we can just write in bracket economic benefits remains with the customer. Moreover, they can direct the use of that particular asset. So we first talked about this control and risk and reward thing and all. Another thing about technical part we talked about is separate identifiable asset. Either the structure you can follow is, you can talk, told about control and thing and all, you can connect it to case study and say why control is there, then talk about separate identifiable asset, then talk from the case study why this is a separate asset. Or else you talk all the technical point first itself, then talk all the case study second. Anything is fine, any track you can go about. So what we can do is, now we told about the technical part, let's slightly connect it to the case study over here and see what all points are there indicating a control. So we found few points over here. Service company cannot change this. Service company, Jared company has the access. Where is it? They control the data on the server. Service company cannot. Okay, before, rather than messing this up, we'll just copy paste and modify it. Copy paste. Server is explicitly identified in the contract. Okay, this is a separate point we can state for that separate identifiable asset, so we'll use it over there. Then in this scenario, service company can only change the server if it stops working. Jared company controls the data which is stored on the server and has integrated the server into its operations. Now maintenance and upgrades and all, no need. Service company cannot determine how the server is used during the term of the contract, nor can it decide whether to modify the server or use it for another purpose. Now we can give a conclusion. All of the above points is an indicator that Jared company controls the asset during the term of the contract and benefit economically from the use of it. Moreover, Jared company has the power to direct the use of the asset as service company cannot interrupt this. Hence, control of asset is passed. So about control is ready. Next thing is about separate identifiable asset. First we have to talk about technically what does this particular point about. Okay, this one we can erase now, that is not needed. Okay. Now, technically speaking, what does separate identifiable asset means? It means that this is about IFRS 16. So within IFRS 16, how can we say a separate identifiable asset? An asset which is specifically mentioned in the lease contract, in that contract that okay, we are providing this particular asset to you. So there needs to be a specific identifiable asset which is explicitly mentioned in the contract. This is when we can say that okay, this is an asset. How can we say that it's a separately identifiable one? Within the contract, if other obligations are also being provided by the lessor. For example, in this case, the lessor, that is service company, they are providing not only the server, they are also providing maintenance and some software backup or some data backup, something is there. Now, it is mentioned in the in the case study that Jared company is paying for the insurance and maintenance of the server separately from annual payment, which means within the contract it is identifiable that for server, that physical device, this much payments are there, and for the maintenance and insurance and whatever else is there, that is having a separate payment. So within the contract it is explicitly mentioned, server is explicitly mentioned and identified in the contract, plus it is separately identifiable from the other services provided by the lessor. In such a case, we can say that this is a separately identifiable asset, plus control has passed, hence, and it is for a specific time period, hence IFRS 16 is to be applied. So this is how we are going to direct our answer. So this point we can use it for our answer. So we'll just copy paste it. Let's see. Separately identifiable asset. Okay, now we can state the point. As per IFRS 16, a separately identifiable asset is an asset that is explicitly mentioned within the contract and it is separately identifiable from other services provided by the lessor. Now we can connect over here. The server is explicitly identified in the contract as mentioned. Moreover, Jared company pays for insurance and maintenance of the server separately from the annual payments. Hence, this asset is separately identifiable from the other maintenance services provided by lessor. So we told about technical part, we told about case study. So hence conclusion, hence as it is a separate specific asset being transferred where control is passed over the contract period, IFRS 16 accounting is to be applied. So this is how we always have to create a structure in our answer before jumping on to conclusions about what our answer content should be. So when you split it accordingly, we know that we are hitting on every requirements and we are scoring all the possible marks in that particular requirement. Now second question is about the calculation bit. Explain with calculation how to account for this. Now calculations, because we have a spreadsheet available to us, we can make use of this, which means we can work on the numbers first and then come backwards and do the explanation part. So what we can do is go back to the spreadsheet and take down the numbers whatever we need. So we are doing now question number 1 related to leases. Now in lease accounting there will be two parts. Always there will be ROU and there will be lease liability. So we'll just keep it in two ends so that we can work on this simultaneously. What all will be the accounting over here? Lease liability generally is the present value of lease liability, meaning what all lease rentals you have to pay in future, and you have to deduct any kind of incentives that you might get, and any kind of excess payment you have to make in future, you have to add on that. So all payments add, all the cost you're going to add, all the pay, all the deductions, all the incentives you're going to reduce. But keep in mind, lease liability is all about future. Whatever is coming up in future, only that you have to deal with. How about ROU? ROU starts with where you stop with lease liability, meaning what all calculations you do under lease liability, you're going to take it over here because that's all about future. Plus, ROU talks about the present as well, meaning at this point of time, what all cost you have incurred already, what all additional cost you have paid, that also you have to add on that original value, and then you have to take the ROU figure. So keep in mind, ROU is present plus future. Lease liability is all about future. So we're going to start with lease liability, get the figures over there, then come back to ROU. So going back to, where is our case study? Yeah, okay, over here. Contract is for 5 years. They told that 1.05 million is the annual lease rentals to be paid, and it's an advance lease, which means when the lease contract starts itself, you're paying that 1.05 million, which means ahead how many more payments you have to make? 4 more payments, because first payment is made on day 1 itself. That means what is your future lease liability? 1.05 million you have to pay every 4 years. So you can connect over here. Cumulative present value of $1 discounted at the 5% rate for 4 years. Why that 4 years is given? Because first payment is happening today, T0. Next payments are T1, T2, T3, T4. So 1, 2, 3, 4, these 4 figures are what we are going to bring back. Since annuity factor is already given over here, we just have to multiply it once in order to get the present value of the total lease liability. So first we can take that 1.05 into 3.546. Present value of lease liability, that is equal to 1.05 million into, how much was it? 3.546. 3.546. So 3.7233. This is the present value of your future payments to make. But there was one catch in this question. They told that you are going to get, Jared company, the lessee is going to get a cashback of 525,000 when on the first anniversary of the contract. When will be the first anniversary? T1. You enter into contract on T0. By T1 you will get that, which means you have to bring this back to today's value and you have to record for that. So how will you account for this? 525,000 you are getting it 1 year later. So in today's terms you have to find it at the present value. What will be the present value? You have to discount it by 5%. So present value of incentive, that is equal to, this was 1.05 million, I'll just make it to 1050 for easier understanding, and this will be 525,000 5%. So equals to 525,000 divided by 1.05. That means we are taking the 5% 1 year discount factor and we're getting the discounted figure, which is 500. Now whatever future figures are there, we have taken into consideration. There was something about legal cost over here. This is already paid by Jared company, so that is something to be discussed under the initial value. Fair value of the server is 5 million and the interest rate implicit in the contract is 5%. Now this is not a matter of concern to us. So with that being said, let's look at the numbers over here. We will take the present value of lease liability, which means the actual T0 figure would be equal to 3.72 million minus 500,000. That will be 3.22 million. And as I said earlier, the ROU figure starts with where we start with lease liability. So we'll just take this line as it is. Oops. Lease liability equals to, how much is it? 3,223.3 million. So this is the present value of lease liability, all about future. Now what we have to do, what all things happen in present we have to consider. What all things happen in present? Number one, on first day itself I pay the lease rental, the first lease rental, that I have to consider, because over here this 3723 is about future 4 rentals. That first rental is not considered in that. So first thing, add initial lease rental. How much was it? 1050, 1.05 million. And there was some legal cost also that you paid on day one. How much is it? 100,000. So that also gets added over here. Initial legal cost paid. Legal cost paid. That is equal to 100,000. What else is there? Cashback we took 1.05. We took 5 million fair value, not a matter of concern. 100,000. And that's it. So this will be equal to this one plus this one plus this one. So the total ROU at T0 is 4373.3. So we have the lease liability figure at T0, ROU figure at T0. Now what happens subsequently on both of this? On ROU, depreciation will be there. On lease liability, you will have the interest climbing up. So on ROU, depreciation we have to record in order to reach to T1. Now what is the time period for the contract? 5 years. So this one divided by 5 years, 874,660. This will be the depreciation amount. So the ROU at T1, that is basically 31st March X3, would turn out to be equal to this one minus this one. So we have the final ROU figure. Okay, this is the carrying value of ROU. How about lease liability? In advance lease, we know that the format is opening minus lease rental plus interest is equal to closing. Now opening figure, we already got it, that present value figure. We minus out the lease rental, so we have the balance amount 3723, which is the present value of all the future payments. Now what happens? Over the year, interest will climb on this. How much is the interest percent? 5% each. So finance cost 5% will be equal to this one into 5%, 161,000. So when the interest climbs on this present value of lease liability, the lease liability at T1, the carrying value will turn out to be this one plus this one. After this, now if you want to do further, what happens after this would be, you have to split this lease liability figure into current and non-current liability. How would that be? We will just minus out the lease rental just to quickly see. Okay, this is an advanced lease, so it's quite easy. Out of this, current liability would be equal to 1050, meaning whatever is the lease rental, that is your current liability. And what would be the non-current liability? The carrying value figure minus the current liability, the balance amount. So we have got all of our numbers that we need for this particular calculation topic. Now, should we stop over here? No, because the question requirement was, let's get rid of all this. Question requirement was, explain with calculation how to measure the carrying amount of ROU and corresponding lease liability in the financial statement at 31st March X3. So we saw how the numbers work. Now we have to explain this briefly as well. So what we have to do, whatever calculations we did, start talking it in words. So we'll just put a slight heading on this. Calculation of ROU and lease liability. So we're going to start off saying about lease liability. Just like how we calculated, we're going to talk over here. So oh god, lease liability is calculated as the present value of all future payments to make and deduct it with present value of any incentives to receive in future. Hence, lease liability on lease liability initially at day 1 would be, the day 1 date was 1st April 20 x2 would be, we'll go to spreadsheet, we can take these, copy, paste. So present value of lease liability is this much, present value of incentive is this much, hence present value is this one. Now how did we calculate? This was this one minus, just to get the answer we'll just put an underline over here. How did we get these number? This was equal to 1.05 million multiplied by 3.546. What was the number? 3.546. So that was the value for present value of lease liability. How did we get the 500? We took 525,000 divided by 1.05. So we basically discounted it by 1 year. Once we deducted, we got the present value of lease liability. We'll just bold it so we know that this is the figure at 1st April x2. Subsequently, interest, that is finance cost of 5% will get added on this lease liability. So what will be the calculation for that? Finance cost will be equal to finance cost is 5%, that is equal to 161.165. How is this calculated? 5% multiplied by 3223.3. Now hence the lease liability, that is carrying value of lease liability at 31st March 20x3 would be equal to 3223.3 plus 161.165 equals to 165. This will be presented within SOFP as current liability is equal to 1.05 million. Okay, I wrote the whole thing, so we'll just write as it is 1050, or okay, we'll just write 1.05 million, and non-current liability is equal to, what was the balance amount? This one. How did we get this number? That is 3384.465 minus 1050. So this is our entire calculation with lease liability. How about ROU? ROU figure initially is calculated as the original lease, as the carrying value of lease liability at day 1 plus any initial payments made. Hence, legal cost and first annual lease rental will be added to this. That will be equal to this one equals to this one. So present value of lease liability initial lease rental 1050, legal cost paid, and ROU at 1st April 20x2. Then what happens? Subsequently, this will be depreciated over 5 years, which is the lease contract period. Hence, annual depreciation would be, what is the annual depreciation figure? Would be, that is equal to, how did we get that? 4373.3 divided by 5. So carrying value of ROU at 31st March 20 x3 would be, carrying values, or we can just copy paste this thing, would be ROU 43, this one, then minus depreciation ROU at 31st March 20 x3. So we have got our lease liability figure and we have got the ROE figure as well. This will be the answer for the entire 9 marks. And as I said, we have done the number work, we have done the explanation bit as well. Now, is it necessary to do it on the Excel sheet? No. Excel sheet was only done so that we get a layout of what we need to present in our answer and we don't make a mistake in our numbers as well. Because first time when you write the numbers over here and when you calculate it, you have to pick a calculator that slows you down and you will not get a structure of what all numbers are there. When you're familiar with the Excel sheet, when you're familiar with this kind of a structure, either from your SBR paper or from your FR paper, you will automatically get an idea about, okay, first comes this, then after this will come, after this will come. So to make your flow of writing that answer little more smooth is why we spent a little 2 minutes extra on these calculations. So this will also be helpful when, if in case you wrote some numbers wrong over here, what you can do is at last you can write refer to spreadsheet for detailed calculations. As always, we can write this note and keep at last so that examiner gets to know that we didn't simply make up some numbers. This is calculated properly in the spreadsheet and that can be referred over there. So if any mistake is there within the word, whatever we copy pasted, if something went wrong, at least that would help us save the marks. So this is how spending some extra 2 minutes in certain areas can ensure we score full marks in every question. So hope that part was clear. Where is our question number 2? Okay, so we're done with question number 1 that was related to calculations and all. Now we don't need any case study over here. This is about cryptocurrency. So why it is not going to meet cash or cash equivalent? So we're going to talk about IA7 from cash flows. Why it's not a financial asset? So we're going to talk from IFRS 9. And finally, why is it an intangible asset? And IS, that is IS 38. So that is all together for 7 marks. As said, no need to refer to any specific exhibit. So before even reading the exhibit, we can continue proceeding with this answer. So starting off with cash, that is the first part of discussion. As per accounting standards, because if in case I don't know if this is IE7, because we are generally only aware of cash flow means we just create operating activity, investing, financing activity. We don't know, mostly nobody knows beyond this what is there in the IA7 accounting standard. So let's assume that I don't know this. So what am I going to write? As per accounting standards or as per IFRS, cash is defined. What is generally cash? Cash means the money that is there in your hand. Why do you use money? It is used for emergency purposes. And from the legal point of view, this is generally a medium of exchange. You use it for transaction purposes. So this is generally a legal tender money which is used in whichever country you're operating in, and that's called cash. So just use your simple logic about what does cash mean and write over here. That's the technical part. So as per IFRS, cash is defined as the cash in hand used for transaction purposes. This is generally the medium of exchange and legal tender money tender money in whichever country it is being used. Meaning wherever that cash is being used, if it's a legal tender money, that is the case. For example, you cannot go use dollar in India and say that this is the legal tender money here. Though it's a medium of exchange, it's a cash. You need to use rupees in order to get something. You can't use dollar over there. So that's the simple idea. It's generally a medium of exchange. So we told what is cash. Now we have to tell why crypto is not a cash. Cryptocurrency, though, is used as a medium of exchange in certain scenarios. What are those certain scenarios? Sometimes in not in like small countries and all, in western countries and all, we can see that certain companies and all deal or sell cryptocurrencies that they hold in order to get some properties and all. So what they're doing over there is they're using that crypto as a medium of exchange in order to get items. But that's not going to work always, because you cannot use cryptocurrency in order to go buy supermarket groceries and all. So that's not going to work out, which means it's not a legal tender money or a medium of exchange in every scenario yet. So cryptocurrency, though, is used as a medium of exchange in certain scenarios, it is not legally a it's not a legal tender money or a currency in a particular country widespread yet. Hence it can't be defined as a cash. So cash does not work out. Now you have to tell what is cash equivalent. As per IFRS, cash equivalent. So what is cash in your hand? Cash equivalent means it's almost like in your hand itself, which means if you want it, you can make it into cash easily. Which means as per IFRS, cash equivalent means an item, an investment or something, an asset that you can readily change it into cash. Okay, it's a highly liquid item. It is kept for like a short term investment. You put that money somewhere for short term period. You can make this into money very quickly. So this is what cash equivalent means. Plus this is not very volatile. It's not affecting with fair value changes, or significant risk in value movements are not there. So this is what cash equivalent means. So as per IFRS, cash equivalent means a short term investment which can be highly liquid and not affected by significant value changes. Now that's cash equivalent. However, cryptocurrencies can only be liquidated if an active market exists for it. Moreover, it is highly volatile in its price fluctuations. Hence, cryptocurrency is not a cash equivalent. Next thing is financial asset. That is very common as per IFRS 9. Financial asset represents either an investment in equity. What does investment in equity mean? You have some shareholding over there. You have an ability to get some returns like dividend. So investment in equity, that is investment in the residual interest of a company, or a right to receive some contractual cash flows. So this is what generally investment in equity means, or it is the a contract where you are going to exchange financial assets for something where you are in a favorable position. We can write that as well. So, or you can just change this contractual cash flow, we'll use it for debt, so we'll just change this thing, or a contractual agreement to exchange contractual agreement to exchange financial assets in a favorable situation, and or investment in debt, which is a right to receive contractual cash flows, meaning like fixed interest returns or something could come up. We can just write no, fixed right to receive contractual cash flow. Okay. So investment equity or investment in debt is what financial asset means. Cryptocurrency doesn't represent an ownership in equity of a company, or does not entitle the holder to any kind of contractual cash flows from it. Hence, it is not a financial asset either. So we told why it's not a financial asset as well, because crypto holders won't get anything in return. They mostly benefit only from capital movements. Now finally we have to tell why this is an intangible asset. As per IAS 38, intangible asset means an asset that is having no physical form and is a separately identifiable asset. Currently, only IAS 38 holds some connection to account for cryptocurrency by its nature, as cryptocurrencies are digital, means no physical form, and is a separately identifiable asset from other intangible assets of the company. Like example, it's separate from patents, it is separate from trademarks, it is separate from brand value. So it's a separately identifiable asset which you can buy and sell. So hence cryptocurrency can be accounted for using IAS 38. So does that mean IAS 38 is the absolute best accounting standard? No. They just wanted to get an answer from us why this may meet the definition of an intangible asset. They didn't ask you why it cannot be a intangible asset, or what could be the drawbacks in that. So you don't have to tell that even if you know. So stick to the requirement, whatever they asked, give that answer only. So we're done with the 7 marks discussion over here. We didn't utilize any case study over here. We just talked about from theoretical knowledge what we know about cryptocurrency and the reporting accounting issues with it. Now moving on to exhibit 2, that is related to how discuss the steps that Jared company should take to measure the fair value of cryptocurrency in accordance with IFRS 13 fair value, and always be careful with the conjunctions, very important, and briefly explain the impact of the fair value measurement on the financial statement. So now we have to read the second part over here, cryptocurrency. The directors of Jared Company believe that measurement guidance in IFRS accounting standard does not provide relevant advice on cryptocurrency valuation to help them prepare their financial statement. After consulting the external auditors, directors of Jared intend to account for the company's cryptocurrency holding using their evaluation model in IAS 38. Okay. Because the auditors do not believe that cryptocurrency meets the definition of cash or cash equivalent or that of a financial asset. So basically, this is where that question came from. But considering that they themselves told in the requirement no need to connect it to any kind of exhibit or so, we didn't have to read this. So that paragraph, just skip it anyways. Next thing, on 1st Jan X3, that is 3 months before the year end, Jared company purchased 1000 units of a cryptocurrency for $6,500 per unit. So 6,500 into 1000 units will be 3 more zeros, so that's 6.5 million. Cryptocurrency is traded in several markets with different prices being quoted in each market. So it is traded in several market gives an indication that there's an active market for this particular asset where lot of sale is happening, meaning transactions are happening. Now, different prices are being quoted in each market as there is no single price for the cryptocurrency. All right. Jared company cannot access every market as some markets have restriction which affect the trading of cryptocurrency. So we're not going to utilize those values in order to find out what would be the fair value, because the question was asking as per IFRS 13, how am I going to use the fair value rules in order to get the value of this particular cryptocurrency. So if there are some restrictions on certain markets, that means it is not, there is conditions under IFRS 13 like physically possible, legally permissible, financially something. So there's like 3 points over there which states that I cannot take some random fair value just because it is there in the market. It needs to be something that I can utilize as well. Only then I can use it in my books. So if I cannot access that market, it means even if the fair value is like too high, I'm not going to benefit from this. So if I show it in my financial statement, that would be manipulation. So I'm not going to take that. Now, markets are volatile and trade 24 hours a day. All right. Markets and related information are set out below. Market size. So 45 million worth. Okay, transactions per day, 1500 transactions. Price per unit at the close of business, 31st March X3. Okay, basically at the reporting date, these are the prices in each of these markets. Now, what was the value of our item? 6.5 million. Now, here they are telling there's a market size of 45 million, so that's way beyond our 6.5 million target. But they're giving one column over here, restriction allows trading for values less than $10,000. That means if price fluctuations happen, for example, our item is 6.5 million, this product is 6,700 in that market, which means in total, if 1000 units are there, it would be worth 6.7 million in that market. By default, if I am a crypto investor, when market value goes up, I would go and sell this. So I would make use of that 6.5 million, 6.7 million, that 200,000 gain I would make use of. But they're telling that it allows trading only for less than $10,000, which means I can merely sell probably just 2 units or just 1.5 unit. That's it. I cannot sell all the units and make money out of this. That means even though value in this market is high, I cannot, make use of this. So market A is out. I cannot take any benefit from this. Let's go to market B. 200 million volume is there, so big market. 10,000 transactions per day, all good. 6,800, so fair value went up. If in case it's possible to achieve this, then it's a good thing. Now, trading in cryptocurrency needs a license which can only be obtained by financial institution. Now, what is this Jared company? Is this a financial institution? Was something mentioned earlier? No, they're in server contract, they're leasing. They didn't mention anything about whether this is a financial institution or not. No, nothing is there. So no information about whether it's a financial institution. Hardware based server, head office, contract, integrated. So nothing specifically is mentioned. Considering that we don't know, we can just say that we don't know in the answer. Meaning we don't know whether it's a financial institution or not, so we don't know whether they can obtain the license. So we can write as it is. So because no information is given, what kind of companies are it companies. Next thing, see, trading in okay, 4 million is the size, big figure. For then 250,000 transactions per day, 6,300. Okay, all that is good. Trading in the cryptocurrency is on the derivatives market and is not subject to specific regulation, which means comparatively the restrictions are a little more free over there. So C can be considered. D, 4 point, not 4,250 million. Okay, so these two are like big volume transaction. 275,000 transactions per day. This also looks fine. 6.35 million. Okay, that is the closing figure. Fine. Trading in cryptocurrency is on the derivative market. okay, this is same, is not subject to specific regulation. Okay, so these both will work out. C and D is fine. E, 560,000, no, 560 million transaction, 560 million market size, 3,500 transactions per day, 7560. Okay, this has the highest value already. Although there is no direct ban on the trading of cryptocurrency, there are very strict rules which makes trading in cryptocurrency a difficult process. So if it's a difficult process and price fluctuations are very volatile, it means that if in case this is a massive fluctuation that happened from 6,500, it is now worth 7,560. So if you are selling it on each unit, you can make big amount of profit. So almost a total of 1.1 million profit you can make in this entire thing. But because trading is really a difficult process, you probably will not be able to sell this entire thing and make money out of it. Considering it's very volatile, process has to be really quick. So E is probably not going to work out either. So from the case study, now we understood that C and D are the markets that we can choose. Now furthermore, we have this concept under IFRS 13 called as principal market, most advantageous market and all. Now, out of this, currently my value is 6,500 opening. Now by the end of the year, either it's 6,300 or 6,350 I have to use. From 6,500, it's falling down to 6,300. 6,500 falling down to 6,350, which is a smaller fall, 6,350. So that is the most advantageous market. So option D will be our answer. Now, I mean, market D will be our answer. But now we have to frame this entire thing into a solution, because we understood what all things we have to find out, which market we have to go and all. Accounting also we understood. Initially it's 6,500. Later it will be 6,350. That means 150,000 fall happened that we have to record as a loss. Your financial asset value goes down. All that is clear. But first we have to talk about the technical part, case study. We have to get into that answer. So that we are going to frame now. So let's go back to our word processor. Question is, first thing, discuss the steps that they should take to measure the fair value of cryptocurrency in accordance with IFRS 13. So first let's talk about the IFRS 13 rules. How the mark allocation is going to be. Question is altogether for 9 marks. Two parts are there to talk about. Second part is dealing with numericals and calculation that we already understood. Since we already understood, we can finish this off, that part very quickly so that we can get the marks easily. But let's go in order itself. Now, first we're going to just roughly give around 3 to 4 marks over here, because the number work was very less. Now it's already discussed and it was like 2 to 3 lines only. So this will be only probably 2 to 3 marks. And the remaining thing is going to be, let's say, 5 to 6 marks. So that's how we're going to allocate the marks. Within that 5 to 6 marks, technical part about IFRS 13, around 3 marks would be there. Another 3 marks would be there for your what is this called, case study part. So we have to connect it. So this is how we are going to spread out our answer. First, talking about the technical part, IFRS 13. As per IFRS 13, fair value measurement involves taking values, or first we can say what is fair value. Okay. As per IFRS 13, fair value means the value of an asset or liability traded in a normal market between market participants in an orderly transaction at a specific date. Now, for fair value measurement, IFRS 13 provides a fair value hierarchy where values are to be taken from level 1 inputs. What is level 1 input? Identical assets, active market, quoted price. Level 2 inputs. What is that? Similar assets in in active market or identical assets in inactive market. Do we have quoted price over here? No, we have only observable price in inactive market, and we have observable price over here. Finally, level 3 inputs. This will be non-observable observable data, which means this is based on estimations. Now, this part we can connect to case study and say that there are many markets available over here. Quoted prices are also there, and it is very active because the volume of transaction is quite high. So active market is available and all the things are there. So we can say that an active market represents a market with high volume and frequency of transaction. For the cryptocurrency, though with some restrictions, there are 5 active markets for it with quoted price. Hence, level 1 inputs are available. Now, we told about active market is existing and level 1 inputs are there. But we told a point about this financially feasible, legally permissible, all those things. Which simply, if in case I don't know those points, what I can say is IFRS 13 says that even if an active market is there, I can consider the values from it only if it is possible for me to utilize or benefit from it. So I can bring that point up. As per IFRS 13, even if active markets exist for a particular asset, it can be taken into consideration only if the values in it can be obtained or benefited by the company. That is, restrictions aren't there. Now we told about the case study. I'm sorry, technical part. Connected to case study, we told that I think some 3 markets we cannot go with. I think it was A, B, C, and no, A, B, and E. So why A we cannot go? Less than 10,000. So we can take one by one each market and say the situation. Market A cannot be considered as transaction limit of $10,000 is there, while Jared company has cryptos worth $6.5 million. So hence cannot utilize from the fair value gain because their value went up. Next one was market B. Market B, we told that we don't know what kind of company this is, so we don't know whether trading license can be obtained or not. So market B, trading license can only be obtained by financial institution. There is lack in clarity of what industry Jared company operates in, and hence this market can be ignored because we don't know whether they can obtain it or not. Third one which we have to ignore was E. Why did we ignore that? Difficult process. Okay. Market C. No, market E. Market E. Even though fair value gain from this market would be the greatest because that one had 7,000 something greatest, there is difficulty in trading process. Hence, as crypto value is highly volatile, Jared company may not be able to utilize this benefit. Hence, market E have to be ignored. So this leaves us with market C and D. Now market C and D is almost equal to each other. So how did we choose market D instead of C? By the rule concept of most advantageous market, the market where most benefit is going to come for Jared company. So we are going to talk about that. When multiple markets with similar values and transaction volume exist, IFRS 13 applies the concept of most advantageous market to choose between them. What is most advantageous market? Most advantageous market represents the market in which, or the market price at which an entity can make the most benefit out of. As the fair value, I know, as the, what is it, what value was it, price per unit, okay, as price per unit in market D is greater than market C, market D would be the most advantageous market for Jared company. Hence, the fair value of dollar, how much was it? Dollar 6350. Okay, dollar 6350 has have to be considered as the fair value at year end. Now we told about the IFRS 13 accounting, I mean the whole accounting process of how to choose the fair value. That was the first part. Discuss the steps which we will take in order to measure this. And a small portion remains. Briefly explain the impact of this measurement on financial statement. Now we're going to talk about the accounting part. Initially, as investment is an intangible asset, as per IAS 38, would be measured at cost, meaning initial purchase price. This would be how much was it? $6,500 multiplied by 1000 units is equal to $6.5 million. By year end, this would be transferred to fair value down to $6350 into 1000 units is equal to $6.35 million. Hence, a loss of 6.35455, okay, $150,000 should be recorded within SOPL, because as per IAS 38, when value goes up it's OCI, when value goes down it is SOPL. So hence a loss of $150,000 should be recorded within SOPL. Just write the entry as well. Debit expense or debit impairment, we can say debit impairment loss $150,000, credit investment in crypto $150,000. So non-current asset falls down, expense goes into SOPL. So this will be the whole answer for our, how much marks was it? For our 9-mark question with regards to the crypto accounting and IFRS 13 and all the points before that. Hope you have followed with all the calculations and all the discussions that we have done in this particular video. Hope this was helpful to you in structuring your answers and with dealing with accounting standards and a relevant topic for your exam related to cryptocurrency. Hope the structure was clear to you on how we cracked each of these answers and how we made sure that mark allocation was our first and most priority item before even starting to write the answer. With that being said, we are done with question number 3. See you with the next video in question number 4. See you soon.